give it a minute while we allow everyone to have a chance to log on and get settled. Some handy instructions there for you in the housekeeping to make sure that you can view the webinar. Okay. Well, welcome to our fund update and understanding your defined benefit webinar. Before we do start, I just want to remind you that what we present to you today is information of a general nature. We're not taking into account your individual personal financial circumstances. If you want to speak with someone about your situation and get some financial advice, we recommend that you speak with a financial advisor. At a point later on in this presentation, we'll elaborate on the financial advice services available at Brighter Super, and we'll provide some contact details for you. And again, hello and welcome, and thanks for attending. My name's Rebecca Harvey, and I'm part of the key member team at Brighter Super. I've been with the fund, the founding fund of Energy Super, for 4 years and have probably met quite a few of you. I've looked after members from all the way from Wide Bay all the way up to Cairns, and still look after those members today. Also on our call is Mark Rabius, one of our fund employed financial advisors, who has over 10 years experience with the fund. He'll be helping us today as to how financial advice services and how they might benefit someone contemplating leaving the defined benefit scheme. Also, Peter Hoban, he's going to be our moderator for any questions you may have today. Peter's also part of the team and he regularly goes to Townsville, and some of you may have met Peter. He also looks after some members in our Brisbane area. Before we start, I'd also like to introduce Lisa Kay. She's our Chief Experience Officer and will be giving us a fund update. But before we hand over to Lisa, let's just have a look at the agenda. So we're going to do an overview of defined benefits for you today, how those benefits are calculated, and what happens and the considerations you need to have when you're leaving defined benefits. We'll wrap that up with some key takeouts, and of course, we want to hear your questions. For now, though, I'll hand over to Lisa Kay.
Thanks very much, Rebecca, and hello to everybody. I've met a lot of our members over the past 5 years, just over 5 years since I've been with the Foundation Fund of Energy Super, and then through to LJ Super, and now I'm proudly the Chief Experience Officer at Brighter Super, and we are right by your side, as you can see on this screen. Next slide, please, Rebecca. Thank you. So where are we headed? As you know, we've been sending out a lot of communication lately, which explains to you the journey that we've been on through the migration and the harmonisation of LGA Super and Energy Super following the merger in June 2021, and then the acquisition of Suncorp Super. Suncorp Super is known to us as SPSL, which is an acronym of their trading name. So we have now formed and have launched the name of Brighter Super, which is what you'll be seeing on all of your communications from now on. So we'll be delivering more benefits to our members, but what we will be focusing on is the same member experience. And for me, it'll be about uplifting that member experience. So we're going to prove to you why we're a different fund and why we're not a mega fund. We don't have an aspiration to be a mega fund, but our value proposition is very much being boutique at scale. And what that means for you, and what we are determined to demonstrate to you, is that we have an intimate relationship with our members. We travel the whole of Queensland in our meetings with members, and we meet with members on a member basis. We meet with more members than most funds do. So you will have met a lot of people within Energy Super, LGA Super, now Brighter Super, over the past months, and we're looking forward to meeting you at your workplace and in your local area, and for some people in our offices in Townsville. Next slide, please, Rebecca. Bit of a delay. So Energy Super, as you know, was our foundation fund that represented the energy sector, and we will remain really invested in the energy sector, and it will always be important to us. It will always be a significant part of our history, but most importantly, a significant part of our future as well. So while we no longer have that synonymous brand known as Energy Super, that doesn't change the way we focus on our energy members, the way we work and meet with you in your depots and in your workplaces across Queensland, and how we communicate with you and continue to do things like these really great webinar presentations and also forums across the state. Thanks, Rebecca. So I want to talk to you a little bit about some of the benefits that have come from the merger of LGA Super and Energy Super, and probably the most important and the one that determines, you know, why we would make this decision is the fact that we can deliver reduced fees for our membership. And for some members of Brighter Super, there's been a reduction of up to 28% on the administration fee that we've been able to deliver on the annual cost to our members. That's really significant. That's one of the things that APRA measure in terms of whether or not a merger is appropriate and whether we're acting in the member's best financial interests in doing so. So not only have we reduced our fees, and we will continue to reduce our fees, you can look forward to that in the future. We can do that thanks to the size and scale of our business. Scale allows us to deliver better savings to our members. It also allows us to deliver more services, and with our continued personal spark that we will always have, we will continue to honour the heritage of all three of our predecessor funds, our foundation funds, and we will focus on the long-term performance as we grow into the future. Our service offerings, and you'll see some service offerings coming to you shortly over the next month. We're going to be travelling to Townsville and Cairns. I'll be in both those places. So if you're dialing in today from Townsville and Cairns, I'd love to meet you. We're going to be heading to Billa, one of our favourite places, to Gladstone and to Rockhampton. And that's all within the next 4 weeks. So as you can see, certainly not a reduction in any level of regional attention that we provide to our members, because we really value our regional members. Thanks, Rebecca. So Brighter Super have provided services since the transition. We have done an administration transition. So we're no longer on the platform of Aspire. We are now on a platform, Sonata, provided through Bravura. So what you will have seen through our communications is that we've got a new member online portal. Now, for some of you, that member portal may not be what you were looking for. You may look at it and think it's not quite as good as our old member portal. I want to guarantee you and assure you that this is the very foundation state of the member portal. The member portal, we had the decision in front of us that was either we launch a portal that's got a very basic functionality while we're doing finalising the configuration to add all of these extra elements in, or we can launch early, launch late with everything ready. We decided to launch early so that you're able to see your balance, because we know that that's really important to you. But there have been some changes. You can't, we've seen some additional quote information that you'll be able to get soon. That's coming onto your portal within the next month. And your annual statements will all be returned into your member portal within the next fortnight. So our IT team are working really hard to make sure that you've got that visibility. There are some other features that you've become used to being able to see, and you will be able to see those shortly. One of those is that you previously were able to see your defined benefit balance separate to your accumulation balance. Right now, you can see them only as one total. We will be separating them out so that it's absolutely the same type of information that you used to see. So our defined benefit arrangement has not changed. It hasn't changed in the past and it won't change into the future. Our default insurance premiums are still paid by your employer. The thing that you will see that's a little different on the member online portal is that you can now see the premium amount that your employer pays. So unless you've got an extended insurance premium offering and you pay part of that, the insurance premium you can see there is paid for by your employer. But the thing I'd really like to leave you with that's the most important for me is that Brighter Super is still a not-for-profit industry super fund. That is who we were in the past, that is who we are today, and that is absolutely who we will be into the future. That will not change. That is our philosophy, and that is our board philosophy and won't change. Thanks, Rebecca.
Thanks, Lisa.
I'm going to be handing back to Rebecca now, who's going to be taking you through the defined benefits presentation, and I'll be back at the end at question time. So thanks very much again for joining us.
Thanks, Lisa. Okay, let's move into the some of the main content of today, which is understanding your defined benefit. Okay, so let's have a look at the two main elements of your defined benefit contributions. Your super contributions are paid into two places, one being the defined benefit pool and the other your accumulation account attached to your DB account. Your employer's contributions are not paid into an account in your name, they're actually paid into the DB pool. The rate at which your employer pays into this pool is determined by the fund's actuary each year to ensure that your benefits are always fully funded. Your compulsory member contributions are paid into what is called your member account and are also invested in the DB pool. For example, 5% are standard contribution before tax, or 5% after tax, or 5.88% if you choose to pay that through salary sacrifice. The money in this defined benefit pool is invested primarily in shares, property, alternative assets with some allocation of fixed interest and cash assets to provide some stability of returns. And they provide a similar return as the conservative balanced option. You don't share that investment risk in the DB pool. Your employer bears this risk. Your defined benefit balance is payable according to a formula, which is independent of investment returns of the DB pool, and we'll elaborate on that later. The fund also lets you make voluntary contributions in addition to your compulsory member contributions to your super account. Any additional voluntary contributions or rollovers from other funds you make are invested into a separate portion of your account. This is called your accumulation account. You can invest your voluntary contribution funds into Brighter Super's available investment options. So your accumulation account balance will grow by virtue of the amounts you contribute and their investment returns over time. Before we proceed, let's have a quick look at some of the frequently used defined benefit or DB account terms that we use. The first one's your final average salary, or we call that your FAS. It's the average of your super salary advised to Brighter Super by your employer each year when you leave. Each year and when you leave. The average period is 1 year, except for those who work at NRG, and for them, it's over 2 years. Your member benefit multiple, and we also call that MBM, is the figure used to multiply your final average salary when calculating your DB balance. It's calculated by multiplying the years and part thereof you've been a defined benefit member, and we multiply that by 19.5. It ceases to accrue at age 70, and for NRG, it's 65. If you're still working at that point in time, you're then moved into the defined contribution account, and we'll talk a bit more about that. An age-based reserve factor comes into play if you're under 55 and you're retrenched, you resign, or you have to leave because of ill health. This reserve factor reduces your defined benefit by 0.02 for every year that you're under the age of 55. A notional taxed contribution for DB members is an amount of money that is considered by the ATO to have been paid into your super account by your employer, irrespective of the amount contributed to that DB pool by your employer in the financial year. This results from the structure of defined benefits where employers must contribute an actual amount of money to ensure your benefit is fully funded at all times, irrespective of any salary changes or investment market fluctuations. It's used in calculating your concessional contributions each year. Your total concessional contributions will include this notional contribution amount, as well as any other additional voluntary contributions you make. And you can keep an eye on this figure at any time throughout the year by contacting us. And you will note that those contributions in total have a cap of $27,500. Right, let's have a look at the disability benefits that are within your defined benefits. Your benefits include a temporary disablement benefit, an optional income protection cover to age 65, and death and total permanent disability benefits. Let's have a look at those in a little bit more detail. A temporary disablement benefit is available and paid fortnightly if you are less than 65 years old and you have been absent from work due to disablement for a continuous period of 30 days, and you've used up all your sick leave, and the disablement is of course accepted by your insurer and makes you temporarily incapable of carrying out the duties of your office or position. The amount of the benefit is 80% of your superannuation salary at the time you come entitled to receiving the benefit. That the benefit payable may be reduced if you're receiving benefits from other sources. The maximum benefit, including any other benefits, can't exceed 80% of your superannuation salary. I will just make a note that this excludes NRG members. Let's have a look at income protection to age 65. So if you're in regular employment and working an average of at least 14 hours per week, you can also apply to extend your temporary disablement benefit payment period beyond the original 2 years up to the age of 65. That's subject to our underwriting and potential medical assessment. And of course, you need to accept that as accept any conditions that may be applied as well. To be able to pay for this option, because you would need to pay for that, you must have sufficient funds within an accumulation account in Brighter Super. Insurance costs are deducted monthly from your accumulation account. And again, this excludes NRG. Let's have a look at death benefit. It's paid to your dependents or your legal personal representative if you die while you're a member of Brighter Super. The benefit is calculated if you're over 60 or younger at the date of your death benefit is equal to your member benefit multiple at age 60, multiplied by your projected FAS, so your final average salary at 60, and subject to the benefit being a minimum of 2.5 times the balance of your member account immediately before you reach 55, and the benefit being no less than your minimum requisite benefit as determined by the fund's actuary. Your total and permanent disablement cover is a lump sum calculated in the same way of your death benefit. Generally, this benefit arises when, in the opinion of the trustee and the insurer, after taking into account relevant medical evidence, you are considered to be totally and permanently disabled. You would be considered to be totally and permanently disabled if you meet the relevant TPD definition in place at the time of your disablement. Okay, let's have a look at how the 3 tests work within defined benefits. So if you retire between the ages of 55 and 70, for NRG members at 65, your benefit will be the greater of the final average salary multiplied by your member benefit, or 2.5 times the balance in your member account immediately before you reach the age of 55, or your minimum requisite benefit, as is determined by the fund's actuary. Added to this will be your accumulation account balance. So the minimum requisite benefit is calculated each year by the fund's actuary. It's actually a calculation amount the DB member would have received if the DB member was receiving the employer's super guarantee contribution instead. So you can't be any worse off than if you were receiving the super guarantee contribution. Your member account consists of your compulsory contributions and investment returns, less tax deductions invested in the DB pool. That's in regards to point 2. So let's have a look at some how this is actually calculated, because I gave you a lot of words then and a lot of different calculations. But first, before I do that, you can contact the fund, by the way, at any time, where we can actually provide you with your current details in regards to your account and how your personal test is, whether it's 1, 2, or 3, those ones I just went through. So this quote is calculated by using the most recent super salary that's provided by your employer. They provide this information usually to us in March and of September of each year. We use this salary information to produce your balance calculations, so that in a sense it's always an estimate based on the latest information we have from your employer. When you do leave your employer or your defined benefit, your employer will provide us with your superannuation salary at your termination date. It's just a reminder as well that for the final average salary, for most people, it's 12 months, and for NRG, it's over 2 years or 24 months. So you'll see there's an extract of the benefit quote that you'd currently be seeing on your member online. So it does currently cover off your total balance, your taxable components, and also your insurance at the moment. And as Lisa talked about, we're currently looking at upgrading and progressing that through the stages, so you'll be able to see more and more information as we go. But until then, make sure you just get in touch with us and we'll be able to help you. The next thing we need to do is look at your member benefit multiple. There is no maximum multiple, but it will stop accruing at the age of 70, or for NRG, 65. Your multiple is calculated by multiplying your full-time defined benefit fund membership period in years or part thereof. Think of it basically as time, so how much time you've been in the defined benefit fund multiplied by 19.5. It's important to note, though, that for any periods that you work less than full time, or maybe you take leave without pay, your multiple will change proportionately for that period. Okay, if you're a member under 55, your defined benefit calculation is basically the same calculation as when you're over 55, but with a bit of a slight difference. This calculation will apply, as I said, if you're under 55 and are retrenched, you resign, or have to leave due to ill health. The DB formula is the same, but it's affected by the age-based member reserve. So your defined benefit balance is your FAS multiplied by your member benefit multiple, then discounted by 0.02 for each year you're under the age of 55. This factor will not be less than 0.7 and applies to anyone under 55. Let's have a look at a case study. It may make a bit more sense when we look at it this way. So Joe retires on his 63rd birthday and he joined Brighter Super on his 29th birthday. His member benefit multiple is then 34 years multiplied by 0.195, which equates to 6.63 member benefit multiple. His FAS, or final average salary, is 65,000 and his accumulation balance is 50,876. And his member account balance at 55 was 69,101. Let's have a look at what that looks like. So what will Joe's retirement benefit be? Basically, Joe's retirement benefit will be whichever is the greater of all three of those formulas. And we obviously work that out for you. So it's nothing you need to stress about. You will always get the highest. But the winner was Formula 1. So it was the final average salary multiplied by the member benefit multiple, and which equated to 430,950. Formula 2, as you can see, was 172,752. And under the member requisite benefit, it was 321. So Joe's highest calculated balance is the 430,950 plus his accumulation amount of 50,876. So his total retirement benefit is 481,826. Also, if you're wanting some more information, because I did just go through a lot of detail about defined benefit, and you're the type of person who loves to read and digest things and wants a little more information, you can download our DB PDS online, so our DB product disclosure statement. There are a lot of calculations that are involved, so if you'd like to sit down and work your way through things, it's a really handy document. Just search defined benefit guides in the search bar on our homepage and the links will come up. or even just give us a call and request to have one emailed to you. And of course, you can always ring us and we're always happy to help. Okay, I went one too quick. There we go. What happens when I leave DB and what do I need to do? So let's have a look at that. Firstly, before we get too far into it, some of you may have heard or may not have heard about the no disadvantage policy. That's been in place between you and your employer. This may not be for everybody, so let's just run through it. This has come about because of the past pay freeze on your wage increases. This policy ensures that if you are a retiring DB member, your super benefit will not be affected as a result of the wage deferral required under the government-owned corporations wages and industrial relations policy. This policy is the mechanism that makes sure that you get a no disadvantage payment from your employer. That is the difference between the superannuation benefit paid to you based on your actual salary at the time and the superannuation benefit that would have been paid to you without the wage deferral. The payment doesn't come from us here at Brighter Super. It's actually paid to you by your employer. Brighter Super provides the information about your super salary and all relevant information to an actuary who confirms the amount of the payment with your employer. The amount is grossed up by your employer and then paid to your bank account. And then they will give you a PAYG statement and you'll need to use that for taxation purposes. You need to be a defined benefit member where your EBA wage increase has been deferred. So I'll leave you to decide if that's you. You're retiring after your preservation age, or you've passed away, you're permanently disabled, you have a terminal medical condition, or you resign, or your role is made redundant after you've reached your preservation age. It should be noted that from 12 months after ceasing employment, the no disadvantage payment will not be available. I did just talk a little bit about preservation age a couple of times. So what are these ages and the dates of birth on this slide mean? Your preservation age is generally the earliest age you can access your super, and it's calculated based on your date of birth. This is all about basically when can I also access my money. Your money currently is locked away until you reach a certain age, your preservation age. So when you reach a preservation, you can potentially start accessing your super partly or in full if you meet what is called a condition of release. Conditions of release cover a wide range of circumstances when a release of benefits is permitted. Some have restrictions on the form of benefit, for example, lump sum or income stream, or the amount of benefit payable. These are known as cashing restrictions. If you meet a condition of release with zero cashing restrictions, the preserved and restricted non-preserved benefits in your account will become unrestricted non-preserved. Clear as mud? Pretty difficult. It's a complex area and it can be confusing. So I'd suggest if you're looking for more clarification about your circumstances, get in contact with us. And of course, our financial advisors are also here to help. So leaving defined benefit, what are the actual next steps? So step one, your funds leave the defined benefit pool. They don't leave the pool until such time as your employer sent us the termination form. We will then take roughly 6 to 8 weeks for those monies to be moved out of the defined benefit pool. The reason for that, we have to wait for the last contributions to come in from your employer and do any last calculations. Once the money does leave the defined benefit pool, your money's transferred to the accumulation account. When it goes to the accumulation account, it will be invested in what's called our default investment option, the cash enhanced option. So we put all your defined benefit into cash enhanced. At that point in time, you then need to make some decisions. So you may want to look for another investment option. We'd really advise that you get some advice as per point 4 around that, so we can give you specific advice about how to invest that based on your personal circumstances. I thought I'd also just take a moment to mention, if you've got smooth return as your accumulation investment amount, it would actually move out of smooth return and go to My Super. And if you have anything in capital guarantee, it'd go to cash enhanced. And that's because they're closed investment options. And once you leave the defined benefits pool, you also have to leave those options as well. So really important, there's quite a lot of moving parts for you at this point in time. Okay, another important thing is insurance. So when you leave defined benefit, the chances are you're still going to have some insurance attached to your account. So when we send you a letter, it's called a crystallisation letter, saying that you've left defined benefit scheme and moved to the defined contribution account, you'll read that we offer you the opportunity to continue this cover in your accumulation account. You have the opportunity to elect to continue this cover or have it cancelled. So you can elect to have the same level of cover, and you can choose to continue this insurance cover at an equivalent level. You must continue this within 30 days of closing your DB account or of receiving that letter in order to obtain the cover without having to be underwritten by the insurer. If you want, you can also look to increase that cover, and of course, it would be subject to any underwriting. Please just know that if you don't elect within the 30 days, you may more than likely have to go through underwriting. Otherwise, we will cancel it after 30 days. Okay, so what are the usual options when you leave defined benefit? Well, you can obviously remain in the workforce. Maybe you're moving into a new role. And of course, you can move your super with you. So we're a fund for life. You can absolutely take your super fund, Brighter Super, to your new employer. We can give you those details and you'd provide them to them. And then they would start to make your super guarantee payments into your super fund. You could obviously take a cash withdrawal depending on your preservation ages, etc. And also you may be looking at going into retirement. So what are the next steps for retirement? And we have Mark on later talking us through that. I'll quickly just cover off some information around genuine redundancy payments. So we do have this from time to time. So payments received by an employee who is dismissed from employment because of their position is genuinely redundant, i.e. the position ceases to exist through no fault of the employee. The employment must be terminated before the 65th birthday or earlier if there is an earlier retirement date in the relevant industry. The payment does not exceed a reasonable arm's length amount, and no arrangement between the employer and the employee for re-employment after the termination of employment. Early retirement scheme payments are essentially the same but apply to a class of employees and are approved by the ATO prior to determination occurring. Sometimes at these points in time of redundancy payments, we start to talk, or members start to think about what do they do with that redundancy payment as well. And there are some certain non-concessional and concessional caps you may wish to consider at that time. So make sure you have a chat with us. There are some tax concessions on genuine redundancy payments, and they are based on the components of the payment, your age, and the length of service. There are a lot of things to consider here, such as how long would your money last? What's your budget? Do you have one? What are your future income options, and so forth. The other thing to note is that it's a great time to obviously get some financial advice. This is a prime time for it. You should be seriously considering arranging an initial appointment with a financial advisor at this point in time. Also, you may want to speak to your accountant as well and your employer about how this will all be taxed. There's also some information here in regards to tax on leave payments in redundancy as well. So let's just have a little read of that. But again, your employer, accountant, financial advisor can give you some information in regards to this. It does also note that any leave payments must be taken as a cash payment. Okay, your benefits from redundancy will come from your employer through the payment itself and your accrued long service and annual leave. You'll also need to make decisions about your superannuation, and these can include retaining amounts in super, making lump sum contributions, and whether to commence an income stream or could be a combination of these as well. So issues to consider: it could be a shock or it could be a pleasant surprise, depends on where you're at in your life journey and employment journey. Your emotions can and of course will impact you. We speak to members quite a lot that are going through this. It's a career crossroad for you. Do you have a roadmap on what are you going to do next? And there's some decisions to be made around lifestyle and financial decisions. So absolutely, it's a great time to seek some help. And with all this in mind, I'm actually going to hand you over to Mark Rabius, who again is one of our fund employed financial advisors. And he can talk to you about the why, the what and the how you can and what you can gain by obtaining financial advice. Over to you, Mark.
Thanks, Beck. I appreciate that. So yes, I've been an advisor with Brighter Super and Energy Super for a number of years. May have spoken to some of you in the past, in fact, and so glad for the opportunity to have a bit of a chat about what it is that we do in my side of things. So as you can see from the slide here, lots of different arrows, and essentially as an advisor, what we're looking to try and do is to understand a person, understand you, what it is you are looking to accomplish with your financial life. We look at things like where you are at the moment, what your assets are, what your expenses are, what dependents you have, what your what you've got at the moment kind of stuff. But then come the harder questions, and we're then going to say, well, what would you like to do? Where would you want to go to? What sort of income figures are you looking for in retirement, and what does your retirement actually look like? And there's also a degree of, in some cases, talking to members about preparing them mentally for retirement as well, because certainly, as like Beck said, something like a redundancy, for instance, is somewhat of a shock, and not necessarily, or you may not have had time to think about, well, what is my retirement going to look like? So what we do is we work out the plan of attack, and then how are we going to accomplish what we're actually looking to achieve for you. So those sort of things can be done over a variety of meetings. It's not necessarily all in the one go. Next slide, please, Beck. So as Beck mentioned, you've got a number of different options within the superannuation fund, and certainly option one is that you can remain working with your new employer, but with Brighter Super as your new superannuation fund. You can retain your insurance where that's appropriate, and certainly that is encouraged for members where the circumstances are appropriate. You've got option two of a cash withdrawal, which, you know, depending on the conditions of release, you may be able to access your capital for living costs. You may be able to use that for, you know, things like paying off debts, purchasing a vehicle, some cases heading off on a holiday. But certainly, as it also says on the slide, that if you're under 60, you may need to consider tax considerations, whereas 60 is a lot easier, and preservation age certainly has to be met. And as the final slide will show, you've got retirement options with regards to, you know, income stream options and so forth. And we've heard already about defined benefits transferring into the accumulation account. And it's really in option three that you get to see how Brighter Super is a fund for life. And Beck mentioned that term as well, because the fund offers a number of different retirement income options depending upon your circumstances. With retirement income products, generally called account-based pensions or income streams, and we use so much jargon in this industry that we use the same multiple terms for essentially the same thing. With those sort of products, you still continue to earn a return. You may have some tax concessions from those. You've got your investment choices, and you've also, in some cases, you'll have the ability to still access lump sum withdrawals, even if you are receiving regular payments. So there's a fair degree of flexibility with those sort of things. And you may have heard either from an advisor or from within your circle of friends, things like minimum payments. So you'll have minimum payment requirements with income stream accounts, but they're, you know, a fairly flexible product. Now, they're not the only thing that as an advisor I'm necessarily going to recommend to people, because at the end of the day, my job is to have a look at your circumstances and work out what's going to work for you. Sometimes an income stream is absolutely a great idea, but there are certainly occasions when it is not a good idea at all. And certainly there are some Centrelink situations where that kind of thing may not be applicable. And one of the things also too is that at the end of the day, it may be the case that we end up having to use all three of those different options, depending upon the person's circumstances. So again, you'll have heard me already saying on a number of occasions, circumstances, and that's really what it boils down to. Next slide, please, Beck. Because at the end of the day, it is the individual circumstances that are going to determine what's the most appropriate. And again, coming back to the fact that, you know, you can keep your super with Brighter Super and continue to work. You can, in fact, you don't need to touch your super at all. And that for some people is quite a bit of a shock to the system. If you're in the fortunate position where you perhaps are receiving a redundancy payment or some sort of large leave payment after termination, you may not need to touch your super at all, because you may be able to live off that money. Or You might be in the even more fortunate position to have a spouse earning quite a healthy income. And again, don't need to touch your super because said spouse might be allowing you to live the lifestyle that you're becoming quickly accustomed to. Certainly your insurance within the Brighter Super is an important consideration, both from the point of view of having enough insurance, but also making sure that you don't have insurance you don't need. Because in some cases, particularly if you've decided to keep the insurance cover going, if later on you determine that's not actually necessary, you have the option of cancelling that. And also and I love the picture there with the umbrella and the lazy boy underneath it, is understanding what your vision for retirement is. Because some members that we speak to have, how would you describe it, the champagne lifestyle with only essentially enough money for beer, and that's about it. So you've got to match up your objectives with what you've actually got in the first place. Next slide, please, Beck. So I tend to focus on the financial impacts of retirement. That is certainly where the majority of people I'm seeing are going to come through. But also too, we need to consider the emotional aspects of a person's retirement. And as we can see here, we've got some different stages in our retirement life, shall we call it. We've got the pre-retirement planning time, and that can really vary. Some people are going to come and see us months, years before they retire, trying to work out, are they on the right track? Should they be doing to put themselves in a better position? But then you've got some folk who turn up literally the day they finish or shortly thereafter and going, probably should have done something already, but what can we do now? We've also got to consider from a retirement perspective, that emotional side of things will change as you are in retirement. So you're going to be considering that honeymoon phase, the fact that you're on extended leave essentially until you get to that disenchantment point, perhaps, where you're going, okay, well, this is it. What do I now need to do? What are my next choices? And then reorienting yourself to perhaps new ideas and that sort of thing. And my role as an advisor is not just always to look at that financial side of things, because there's often a relationship that develops where we're actually looking at carrying a person through the ups and the downs of their retirement. I've certainly met clients who in fact have struggled a little bit when they're entering retirement for this first time because of that lack of or loss of identity, should I say. So what might seem a very pleasant and enjoyable and in fact longed for opportunity can actually sometimes for some people not be as terrific as they first thought, and that's not always just a financial thing. So we certainly work with helping to transition people into retirement. But it is true that most people at the end of the day certainly do comment about the fact that, why didn't they retire earlier? They're too busy in their retirement lifestyle, that how could they possibly fit work in, and things of that sort of nature. And I think that shows a bit of a successful retirement planning. Next, please. So again, we've covered these sorts of things on a few occasions. I've already covered that on a little bit, is the fact that you've got option one where you can leave your money in your superannuation account if you want to. You'll then also have option two where you can take your funds out as a lump sum, drop it into the bank, live off that and come back for more. Option three is you've got some sort of combination of lump sum and income stream. Option four is where we've got our income stream. So it's really going to depend at the end of the day on how that's going to work. Tax treatments come into it and overall needs. Next, please. So let's have a quick go through the process. We start with an initial appointment, and that's really a getting to know you. We are not going to answer your question, or we're not going to solve your issues for you. We're not going to give you solutions about how to structure your finances. Answers to questions, sure, but only at a general level, because we want to understand you. We want to understand what it is that you're looking for. And to be completely honest, we want to work out whether we're going to be able to work with you or not, because you may not be able to relate. We may not get on. Because it is a partnership and we want to ensure that we can work together. We also do, and I strongly encourage, and many advisors would, that if you are in a couple, that both are able to make it to that first appointment, because it's really important to get both parties' perspectives on things. It also makes it a lot easier for yourselves in that drive home or that train ride home, where you start questioning and asking, well, what did he actually or she actually say, that you've at least got that other person to bounce your ideas off and so forth. So a great idea. Plus it also allows both partners to have input into that retirement process. And yes, there is paperwork. Unfortunately, it comes with the territory because we need to understand what it is you're looking for. We're then going to put recommendations together. Now, that first appointment, by the way, may spill into a second one, depending how circumstances go, whether things change within your position. We might not have got enough information to begin with, that sort of thing. We'll then put together that written financial document. That is not a small document. It is generally quite a large document, although Labor is looking to try and make some changes there. So fingers crossed we'll have something less than the 70, 80 pages we currently do. But it is a comprehensive document that covers a lot of things. And because of the fact that it is quite comprehensive, we will invariably want to catch up with you to go through the document, not necessarily word for word, but certainly covering the key points. What are the recommendations? Why have we recommended them? What's the benefit for you? We'll also cover things like fees and charges, which are a legal requirement. So at the end of the day, you are as fully informed and educated about the advice as you possibly can be. We then, as the third point says, we then implement your recommendations. So once you're happy, once you understand the recommendations, if you're happy to proceed, we will actually have forms available, which you then can complete, and we then work together with you to get that plan implemented. And then that fourth option is an additional option that people have where they can sign up for a review service. And so we can then review that situation after 12 months to ensure that that is still appropriate. That may involve some tweaking of things, or it might just be a case of, yeah, look, it's all running fine. So that's sort of, in a rather large nutshell, is how that advice process works. So what we'll now do is I'll hand you back to Beck, and she'll then be able to go through the next part of the presentation.
Thanks, Mark. Hang on, I'll just... So we're just going to talk through some key takeaways from what we've heard about today. So that's a wrap, pretty much, but let's just summarise it. We talked about automatic transfers, so to the accumulation section of the Brighter Super. The process will happen automatically when you cease employment. So just knowing that when you leave DB, there's a process in place. Your employer sends it to us. We crystallise and do all those little calculations, and then the funds go into the accumulation account. At that point in time, you've got to remember we're going to put it in the cash enhanced option. So it's important to consider what investment option is suitable for you, your needs and overall objectives. Again, getting some advice. A reminder, you've got 30 days from the date you receive your crystallisation letter to nominate if you want to continue that cover without any underwriting. And of course, seek some advice. When leaving defined benefit, it may be a good time to review superannuation and planning for retirement. I'd actually say it's not maybe, it really is a great time, and I have had many members have quite beneficial conversations at that point. So that's the key takeaways. However, we are going to move into question time as well. So I know Pete is in the background there somewhere, and he might have some questions for us. There he is.
Hi, Beck. Thank you. And thank you, Mark. Good information. We have had some interesting questions come through. And in fact, this is one I was just talking to a member about today, and I think you're well placed to answer it, Beck. How does taking leave with no pay or leave at half pay affect your final average salary for defined benefit calculations?
Okay, so it doesn't affect your final average salary. That bit's okay, because we always end up using the full-time equivalent salary. What it can affect, though, is your member benefit multiple. So if you're taking leave without pay and you're not paying your compulsory DB contribution in, then your employer will actually advise us that there's a period of time where you weren't contributing into the defined benefit pool. And so you'll have a period of time where you were full-time potentially, and then you went to leave without pay, or maybe you went to half pay or part-time work, and that actually affects your multiple. So you've got to consider that when you take leave without pay or at half pay, it can affect that member benefit multiple. However, there is a way that you can consider overcoming that, and that is you have to actually still make your full compulsory full-time contribution, even while you're away on leave without pay. So that 5.88 before tax or 5% after tax. So you can actually arrange that with your employer, have a negotiation with payroll. So you still want to actually make your full contribution as you were making when you're actually working. And that way you will maintain your member benefit multiple as a full-time equivalent. It also makes sure that you maintain your insurance cover as well. Now, the other thing just to note is you may also during this time have to make your employer's contribution into the defined benefit pool as well. So not just paying yours, but also potentially your employer's defined benefit contribution. You may not have to do that if your employer is on a holiday from making contributions, but if they're not, you may have to make that. So you'd need to consider all those as to whether you still make that payment or whether you choose to not make any contributions, but it will affect your member benefit multiple for that period where you're at leave without pay or on half pay, or even if you go part-time. Hopefully that answers the question.
It does, and in fact, probably a good segue into a question we've had that's, I suppose, a little similar. How is your final average salary affected if you reduce the number of hours worked per week in the final years?
It actually doesn't. We actually still take the full-time equivalent salary. So your employer, when you leave, will still give us what your full-time equivalent salary was, even if you're working part-time. Just remembering, though, that the time that you work part-time, that will affect your multiple. It won't affect your final average salary, however.
Excellent,
And
thank you.
Actually, can I just make, sorry, just another little point. We do have a new, we used to have a fact sheet called Defined Benefit Members Working Less on our website. It's just being upgraded at the moment, and it should be back on the website within the next 2 weeks. And this gives you some really handy calculations, actually talks to all of this, and it gives you a chance to read it, look at the calculations and decide, you know, how that may affect you so you can make those decisions.
Great, thank you. Question here from Tony. Tony, hope you're doing well. Who is the current insurance provider?
Did you want me to take that one, Pete?
Absolutely.
Yeah, hi, Tony. Our current insurance provider is Zurich. Zurich went by the name of OnePath. It was an acquisition. Zurich purchased OnePath. So you might remember about 3 years ago, back in about 2019, we moved from MLC onto OnePath Insurance. When we were still Energy Super, Zurich purchased OnePath. So the correspondence that you'll see from the insurer is branded Zurich. So just want to remind you that the insurance that you have as an energy worker is specific to people who work in the energy industry. So this is a group policy that was crafted specifically by Energy Super executive and board to meet the need of the Energy Super workers. So they were workers that work within an energy industry. So it's a very specific insurance policy, because what you do, for some of you, if you're out in, you know, on line work or whatever you're doing, could be considered a dangerous occupation, and we want to make sure that our members pay a reasonable rate for their insurance, or our employers do. So it's been crafted with you in mind. So if you're looking for comparatives in terms of insurance, one of the things that needs to be taken into consideration is dangerous occupations, and whether or not electricians, people who work with electrical equipment, are considered within that particular insurance. I hope that helps, Tony.
Yeah, that's a great answer, Lisa. Mark, I might throw this one to you. When before retirement should you talk to a financial advisor?
That's an interesting question, because, as I said earlier, some people I see literally not rock up on the final day. A good couple of years in some cases, 5 or 10 years. 5 or 10 years can certainly be a time when people catch up. But one of the things that can be difficult when you're that far out from retirement is sometimes having a bit of an idea of the things that you are the important questions. So there's no necessarily perfect answer to that. It really is just a case of getting a bit of an idea as to where you're at. You know, months before, a couple of years before, seen it all, and they can all be just as effective. because in some cases, if you're starting quite a distance before, it gives you more time to do things if you have the capacity. Obviously, you have less time if you're just about there, but you know, any time is a good time almost.
Excellent. Beck, I might ask you this one. It's, I suppose, a little past when people have finished a defined benefit account. But if you set up a pension account after retiring at 60 years old, and then later you do some paid work, are there any problems in doing this with your pension account?
No. What you would have to do though, is if you're not aware, you can't actually make contributions directly into your income stream or pension account. So you'd need to ensure that you have a new accumulation account if you potentially closed it down. And that's quite simple. We can just open it. You can just open a new one. And basically your employer starts making super guarantee payments into that accumulation account. So again, you'd have to pick what investment that you want that money to go into, etc. However, what happens is the money that is paid from that employer or various employers would then be preserved. So you would not be able to access those super guarantee payments until such time as you left employment again. So have left employment. However, your income stream money is still available for you to access.
Great. Mark, another one for you, a bit of a broad one. What is the best investment allocation for defined benefit members?
Well, okay, where's that piece of string and how long is that one? That's a tough one to answer, because I guess for many defined benefit members, they have perhaps not been involved with the market as much as, say, a defined contribution member has, who has had to deal with the market ups and downs all of their working life. So there's a school of thought that the defined benefit member might be more comfortable investing conservatively as they enter retirement. And that's partly why the ex-defined benefit component goes into the cash enhanced option. But that's not necessarily a be all and end all, or has to be the case. What we do in advice, in fact, is we actually discuss with members what their risk profile or risk tolerance is, how comfortable they are with investment risk, and from there work out how they should perhaps be investing their accounts. So again, we try to personalize that. But as I said, it is also fair to say that a lot of ex-defined benefit members do feel a bit more conservative, a bit more wary about the markets, because again, that lack of experience with it. So that's where they tend to be, but that doesn't have to be for everybody. So again, it's that old case of it depends on your circumstances.
Great, thank you. And Lisa, I might group these ones together. I know you did cover it earlier, but you probably like the opportunity just to reiterate this to members. Just some questions around the display of the different components of defined benefit accounts on Member online. A few people just asking, will they be able to see that breakdown again in the future?
Yeah, you absolutely will be able to. Thanks, Pete. This was a means to an end so that we could open up the advisor portal, the member portal, and give you a view of your super balance. But yes, we are doing the development configuration to be able to restore that to the way that it used to appear for Energy Super members prior to the admin migration. So we're hoping that that will be up and running prior to Christmas. It's quite complex. This one is quite a complex piece of configuration. So there are other things that we're prioritising, making sure that your statements are in there, your communications, some other bits and pieces, but you'll definitely have this one, and we'll get it to you as quickly as we possibly can.
Thanks, Lisa. And I've had probably just a 1 minute left, and this is probably a quick one for Mark or Beck. Can you split your investment options, for example, have different levels of risk?
Beck, do you want that one, or you want me to take that one?
Oh, well, you can. We have different investment options within Brighter Super. So you don't have to just be invested in one option. You could be invested across 2 or 3 or all 13 if you wanted to. Not sure that would be the best idea, and I'd get some advice. So yes, you can split it up, and we have ready-made options, and then of course standalone options like Australian shares, international shares, cash, etc. So no, you can split it between various options.
And if I may just tack onto
Yeah.
the back of that, if you've got multiple accounts, for instance, an accumulation account and a pension account, you can most certainly invest each of those accounts differently. So there's no requirement for them to be exactly the same. And so you can literally customize each account as to whatever you fancy.
Great. Well, that's got us to 6:30, so I might throw back to you, Beck.
Righto, thank you. Thank you for all your questions, and thank you to Mark and Lisa for helping out answer those as well. So we're pretty much wrapping up now. It's just a reminder that you can visit brightersuper.com.au, where you can find some great resources on there, the product disclosure statements around defined benefits, and of course and that's located under the resources tab. And in the coming weeks, under that resources tab, we're also going to have that handy fact sheet on defined benefit members working less. So keep an eye on that. Also a reminder that did you know your family and friends can also join? So we're an open super fund, of course, and we're open to everyone. And we'd love to welcome your family and friends as well. So feel free to talk to us in regards to that. And just a reminder as well, here's some handy phone numbers, emails, etc. on how to contact us. So the phone number of 1800 444 396 is our contact centre, or you can email us at advice@brightersuper.com.au. The other thing just to leave you with is that we will be sending you a survey tomorrow. In that survey, obviously ask us some feedback around our presentation today, but also gives you the opportunity to put in your name, some contact details, and basically if you want to be contacted by us because you may have some further questions. So if that's the case, put that in there. Peter and I will get that data, and basically we'll be reaching out and having a chat with you about any questions you might have directly and individually about your own DB and your own account. But otherwise, I really want to thank you all for coming along and listening to us tonight. Make sure you keep in touch with us. We're always happy to answer any questions you have. And have a great evening, and we'll speak to you again soon.